Good morning all and welcome to another one of my videos. The date is the 12th of October 2023 and I have three pairs on watch today. Those are EuroCAD, Pound Aussie and Aussie Kiwi. So no trades for me this week, but we never know what the market has in store for us, which is why we have to show up the same way every day. Okay, we may not have placed a trade for a little while, but this is one of the slippery slopes in trading that if you haven't placed a trade for a little while, you can take your eye off the ball and you can get a little bit sloppy and not be as sharp as you might otherwise have been. And then what happens? The market shapes up, gives you an entry, and then you've gone off and done something else, and then you miss it, and then perhaps your psychology is affected. So that's why we need to remain sharp. So speaking of sharpness, we have a sharp hook point here. So the picture as I see it is we have a sharp move down there, followed by a sharp move up. Okay. It also, just to touch on it, happens to be, since we've been breaking this pair down for a little while in these videos, let's just touch on why price likely reacted from this area. We have this 1, 2, 3 wave move, these three drives that I've spoken about. And then we have this middle section. So we have a 1, 2, 3 middle section within that, and we know that price is much more likely to react to the base of a piece of structure than it is, let's say, a point like this, which is the middle of a piece of structure. So price is much less likely to react from this and move to the upside, as opposed to if an area of value such as this is the base of a piece of structure, the base of a completed structure with 1, 2, 3 touches and a 1, 2, 3 middle section. So it's no surprise to me that when we tapped into this area, that's where we reacted from and not this point here, for example. And we know that we typically move up with a similar level of aggression as we moved up in the past. What do? We move up with a similar level of aggression in the past. We know that we typically break below these higher time frame liquidity points if we're looking for moves to the upside. What happens? We break below this liquidity point and then move to the upside. Okay. So, as I said, the media is typically the higher time frame liquidity points which price breaks below before rallying to the upside and breaks above before selling off, because the media convince people when something's been selling off for a while and it breaks a low such as this. You'll hear things. I heard something yesterday. I can't remember what it was about. I think it was about the pound actually selling off. And, the pound has been reacting from historic lows. Okay. And the media were putting out the narrative on wherever I heard this. I can't even remember now. They were putting out the narrative about the pound keep moving to the downside. The pound's going to keep moving to the downside. And I thought, hold on a minute, it's just reacted from lows and pushed up. So the media are often late with their stories in the first place, which is why, why we don't trade the news typically. But the media have to convince people that something is just going to keep going for people to sell it and get themselves caught the wrong side of the market. So, sell when we break below here. Apparently this is now resistance, and then what happens? It moves to the upside, and then the media forget about it. you don't hear about what they were talking about in the media anymore once prices rally to the upside. Probably because they don't want to admit that they got it wrong, but that's another story for another day. But anyway, we break below, we push back up, and then we have this impulse correction, and I'm just looking for that continuation to the upside. Okay, we know that we typically have the impulse out of a correction is typically of a similar length to the impulse which has preceded it. So if that was to be an impulse correction continuation, that would take us up to here, which makes sense, especially when we have a near miss here. So when price came close to this area, but it didn't quite tap into it. That is why I've got a ray line on here, because these near misses, as we call them, are a very positive confluence factor that price is going to take out the high which it failed to take out last time around. Okay, we can see evidence of that here as we drill down. So we have the base of this structure, we have the impulse up followed by the correction, and this is the base of the structure. We come all the way up, people think it's likely going to keep going, and then it comes down, it gets close to this area, and as I said, there would have been many people waiting for price to get to this area of value when we push down. And then it starts to move before it actually gets there. And many of them would have got long out of FOMO. As I say, we don't know. Not everybody who gets involved in a move has FOMO. But, we can hazard a pretty good guess, given that these patterns that we look for are psychological, that when price started to move from here, many of the people that were waiting for it to get to here experienced some degree of FOMO and started getting long. And then typically what we see is these kind of corrective, uninspiring, unimpressive moves up, and then price come crashing to the downside because the liquidity that is sat here and the orders that are being placed here are dragging price down whilst these people are trying to buy it, which causes it to come crashing to the downside. We then break below a higher time frame liquidity point, as we typically do if we're going to rally to the upside. We break below. I'm sure the media would have gotten hold of this, excuse me, and said that Euro CAD was at a 6-month or 7-month low, excuse me, or whatever they would have put out. It breaks below, breaks straight back in, and then we have this confirmed morning star formation, the bearish candle, the stall in price, and the break below, the washout. And just to touch on it, we wick, this is a key point as well, we wick through the area of value and not to it. When we wick to it, that's often the case when these wicks get filled, but in this instance, we wick through it, so there's no reason for price to come back down, especially as this was a bullish close as well. We then have the confirmed morning star formation, where the body of the next candle closes above the body of this candle, and in this instance closes above the body of this candle as well. Okay, you can see as I drill down, I touched on earlier in the week that many people would have thought, well, this is a bit bearish, maybe it's coming to the downside. But I said, what reason does price have to come to the downside when it's washed out of all of the liquidity and even closed, just to touch on it, above this point as well, the near miss? It has no business coming all the way back down, even though price can do anything at any time. You can see that we broke below the structure in the form of a 1, 2, 3. First drive, second drive, third drive, which pushes up, and we've been moving in by way of impulse correction continuations, okay, which is typically how the market moves. So what I'm going to be looking for today, I do have to be mindful of the time on these videos because TradingView, which I'm recording this on, if you're watching this on YouTube, limits people to 20 minutes per video. So with that in mind, what I'm going to be looking for, we have where did price near miss to? It near missed to here, which just so happens to be where price rallied from last time around. That gives me a clue that the liquidity is likely sat here and just below it. And we also have the 3 drives. What did I say to you yesterday? We have the first drive, second drive, and what have I said in previous videos if you've been watching them? When we get close to an area of value and we near miss it, price tends to move up very correctively because the orders that are sat there, and perhaps here as well, at these lows as well, is dragging price down whilst people are trying to buy this. So we have a little bit of momentum there, but then overall this has been a very non-progressive move, giving me a clue that for this to break to the upside, we need to fill the orders that are there, wash everybody out, and then move. And then we would have that first drive, second drive, and if we tapped into this area, pushed up and flagged, then I would be looking for longs from that area. I would look to get long on the break of the flag or within it. We don't really, although we kind of have a 3-touch structure, this is not really the angle. We don't normally see angles like that. So I wouldn't be looking for, we typically look for risk entries from the edge of structure, but I wouldn't be looking for risk entries down here, because if we break that far below here, typically speaking, as I've said, on the higher time frames, we tend to break the lows before breaking back in. But on the lower time frames, we tend not to move too far away from a point. So if we did have a completed 1, 2, 3 touch structure, by the end of the day, we would have moved quite some distance from here. And if that was the case, we'd likely be forming something different. If this was a higher time frame structure, then if we did push that low, we could still push in theoretically, because we know that people tend to get themselves caught the wrong side of the market on the higher time frames before price pushes back in. So all I'm going to be looking for is a break below here, break back in, and a flag, and then I'll look to get long on the break of the flag, with this being the third drive, as it were, within these 1, 2, potential 3 drives. Okay, that may not happen by the end of the day, but we shall see. So that is Euro CAD. So Pound Aussie. Pound Aussie may not be ready by the end of the day, but one of the reasons I put this on watch is because we have, I forget what it is, some red flag data coming out from the UK at 7 o'clock this morning, which is about 45 minutes time as I speak. So that may act as the catalyst to send price up to my area of value, but I'll touch on that in a second. So what do we have here? We have this impulse correction continuation. It is worth noting that in terms of the range, and this is partly why this is lower down on the list. If we assume that the range is from there to there, we have pulled back a considerable distance of that range when we broke above this high and broke back in. Okay, so this may not be going all the way down to here. This may form something. I'll touch on that in a second, but we have the impulse down followed by the correction. We also have the base of this piece of structure. Once again, okay, the base of a piece of structure. We have the 1, 2, 3 in it, and the 3 drives. So we could theoretically be taking out this near miss to here. Okay, and we have tapped above. We just look at this. If we just zoom in ever so slightly, we have a sharp move up, sharp move down, which is likely where the liquidity is. We wick to that area, but don't break through it. What do we know about the higher time frames? We typically need to break them before breaking back in, and especially when we wick to this area, but in the way of a bullish wick. So I've talked about these green wicks often get filled. Then what happens? We scoot back up, we scoot back up again, and we near miss to this area again, making it more likely that price will gravitate up to that area, break it, and then drop back in. And that's exactly what happens. We break above, catch people the wrong side of the market. The media would have got hold of this, I'm sure. People start buying out of FOMO. It pushes down and we get that impulse correction continuation. So now we're trading well and truly. We've broken below here. We broke below all of this. And now we've got that impulse correction potential continuation again. Because of how far we've pulled up, as I just showed you on the Fibonacci tool, because we've pulled up this far relative to this move from here to here, this could be, and I am mindful of this, this could be some kind of, we may push down to there and then get something like this. Okay, and then we end up with a 1, 2, 3 touch move, which pushes higher, take out this high because of how far we've pulled up from here to here relative to this move down. But even if that is to occur, there's still a lot of profit potential to be made to the downside. Okay, so as I drill down, you can see one of the reasons, I'm just going to, because I've got to speed up a little bit. So one of the reasons I'm not looking at this, you might be thinking, why are you not, because I think previously I was looking at this as an area of value, is because we've built up a lot of volume in here, okay? So if we just measure this as well, so if we just measure the impulse, so looking for the impulse correction continuation to take us up to an area of value before the move to the downside, if we just measure that, okay, if we were looking to get long from here, we would likely push a bit higher, okay? And one of the reasons for that is because of this middle section. So if you just look at this middle section, a lot of volume has built up in this middle section. And when we have a lot of volume built up, it's not normally the case that we just tap into an area like this and then push lower. It's not normally the case that we just tap into the area just above flag and then go. What's normally the case is that we break higher as people that were trading within this range bail out of their positions. And the bigger, typically speaking, this middle section, this range is, typically speaking, the higher it breaks above before breaking back in, okay? Because that's volume accumulation. Price is either finding liquidity at liquidity points or building it, okay? So if it's building it in here, it will likely break higher than if this middle section was smaller, had less depth to it, okay? Hopefully that makes sense. So with that being said, what I'll be looking for is a tap into this area, and if we did tap into the area, there's nothing above really that price could tap into if it's going to move to the downside. So with that in mind, what I'll be looking for is the following. If we tap into this area of value now, because of the reasons I've just explained, we would have a 1, 2, 3, those 3 drives, first drive, second drive. We didn't really move away from this point, so I'm just seeing this as one and the same. But we have that 1, 2, 3 wave move, which would give us a 1, 2, 3, which taps into this area and breaks above this area. and potentially taps out all the orders there. If that was to happen, I would be looking for the push down and the flag, and then I wouldn't be looking for a risk entry from the top, just because the sequence isn't great, and for all of the reasons expressed, and because this, just the sequence basically, and because this is a very larger structure, quite a large structure relative to just large in general. Okay, so you can kind of see it on the 4-hour chart, and to some extent, if I was to move that out of the way, to some extent, I don't know what's going on here, on the daily chart as well. But yeah, so just looking for that, tap into that area, push down on the flag, and then I would look to get short. And even if we only reacted from that trend line, I still have 4 to 5% profit potential, even if price was to react from there for whatever reason and become complex. So that is pound Aussie. So we shall see what happens. As I said, yeah, one of the things I wanted to say is that the data coming out of the UK at 7 o'clock may act as the catalyst which drives price up to this area. Okay, so we shall see. So Aussie Kiwi on the weekly chart, we have this 1, 2, 3 which taps into this area, and then we push down. That's the monthly chart. Do excuse me. Yeah, we have that 1, 2, 3. We tap into that area. We have the middle section within that structure. 1, 2, 3. We move to the downside, and now just looking for this impulse correction continuation to the downside. We do have a near miss here, which is partly why this is lower down on the list. But you can see we are in a run of continuation. We have this impulse correction continuation, a completed 3-touch structure, which you'll see more clearly as we drill down. And you can see we're in a run of momentum, are likely to take out this low and potentially this low before price does anything else. The bigger players will likely be getting out in these areas before a move to the upside occurs, right? And what might happen is we may just push down to there, take out this near miss to here, tap into that area, and then take out that low. But even if that happens, or and potentially continue to the downside, so have the impulse correction continuation. But even if that happens, there's still enough profit potential down to here before anything else would likely occur. So we have that 3-touch structure there. We even have a 1, 2, 3 leading into that. We've corrected below that low, giving me a clue that there was not enough liquidity here to send price to the upside, and that we're likely gravitating towards these lows. Okay. So as I drill down, what I was looking for yesterday is, if I just unhide the forecast, I was looking for this. We have this, price scoops back down, comes back up, takes out these highs, pushes to the downside, scoops back up, takes out this high, pushes to the downside, and then we have this little inflection point here, and a 1, 2, 3 lining up with it, which now has that 1, 2, 3 middle section in the middle. Okay. So you can see that price did reject from this area, but what I'll be looking for is price to push to the downside flag, and then I'll be looking to get short on the break of the flag or within it. Okay, as I've said, these little lower time frame hook points, price tends not to move too far from them if it's going to move to the downside. So if it is going to respond to this area of value, it would likely do so now. And if this shapes up by the end of the day, then I may have an entry on this pair, and I would be able to manage it down to the trend line for something in the region of 3%. A 10 pip stop loss is the minimum that those of us who trade the Falcon strategy go to. We could be forming an M style pattern where we tap into this area, and we have that it's done it again, right? Okay, where we kind of have this. We have that kind of structure, tap into that area, and then push down. But at this moment in time, it's looking like we may reject from this area. So we shall see. And if we push down and we get that move, then that would be great, but we shall see. And that is it from me, folks. I will be back tomorrow, which will be Friday, with another video, providing I have some pairs on watch, or if I've placed a trade. But for now, have a great day, and I'll speak to you again soon. Thanks for watching.